Good evening. This is Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting, and also a venture capitalist. As we speak, Treasury Consulting is a multinational headquartered group based out Singapore. We are a multinational hedge fund who takes positions in US, Europe, and Asia. But like I did repeat it many times, we are a proprietary fund, which means no third party can invest capital in our fund. No third party. I hope you are tracking the markets. Today, Dow Jones is around 30,400. And many senior economists of United States are claiming that Dow Jones can fell to 40%. Now, which means that the Dow Jones can come down to near about 18,000. My consensus is a little bit different. I feel that Dow Jones can collapse more than that because there are more important issues which are coming, like Russia-Ukraine war, China-Taiwan war, the glacier melting, the new viruses which are coming up, and so on and so forth. I know that the media do not give hype to these kind of things. You know, they do not want to discuss about these things. Like today also, I spared around 40 minutes on YouTube. And guys, the kind of videos I saw on the YouTube, basically the videos which are uploaded by the teams, those who are working at the ground in Antarctica or different parts of the globe, scary videos, let it be honest, scary videos. But anyways, I'm not bothered whether anyone is watching this video or not. I myself is watching and keeping me updated. According to the public information, domestic foreign institutional investors, FII, sold around 2.5 lakh crores, around 2.5 lakh crores in the last 8 months. And now tomorrow Federal Reserve would be sharing their view on the June policy. Well, Bloomberg is giving sufficient hype to Federal Reserve, and Barclays also said that we may see 75 pips hike. But my personal view is 50 basis point, although I'm not in agreement of 50 basis point. Because if you are raising 50 basis point, then you are inviting the trouble. Anyways, history is witness that Federal Reserve did these stupidities many times. So this isn't the first time Federal Reserve doing this stupidity. 2 months ago, when Nifty was around 18,200 and I was making the similar videos, people started talking that, you know, the domestic institutional investors would be able to counter the offense by FII and they would continue to make markets at 18,000. And I was a little bit reluctant that how come domestic institutional investors would be able to counter that, and now this is turning out to be a reality. Because from 18,200, now Nifty is at 15,700 and falling. Tomorrow, when the Federal Reserve would be hiking by say 50 bips, then we may see Nifty little bit downwards. Now today I got a document from the Google. You know that I believed in research. I got this document. This document suggests that investments by domestic institutional investors in the Indian stock market crossed 2 trillion mark, which means they crossed 2 trillion, which means 2 lakh crores so far in 2022. Still 6 months to go, which means domestic institutional investors invested almost 2 lakh crores in India and still 6 months to go. Many economists, even if you exclude me, said that the second half, which is July to December of 2022, would be more complicated and volatile than we are having the first half of 2022. It means DII would be investing another $2 trillion in the second half of 2022. By the way, I don't think they are in a position to invest in the second half. There is a reason. Please listen this. According to Jefferies India report, I never trust Jefferies India report because I have seen many times Jefferies India are hyping those stocks who are loss making. But still, according to Jefferies India report, Indian households save 53 trillion annually. I don't think this is a right figure because now we have job losses, inflation is inching up, inflation is in double digit, and income is falling. So this 53 trillion of saving which he's talking about the Indian household, that number needs to be checked because the inflation is going up, job losses. So this 53 trillion number is a little bit heavy number, at least to me, but still. According to Jefferies India, Indian households save 53 trillion annually. And at the current rate of equity allocation in the household, which is around 4.8%, incremental annual equity allocation works out to be 2.52 trillion, of which the SIP is 1.44. Now, this report trying to suggest that the domestic institutional investor, which this article is talking about, is majority the mutual funds. Because systematic investment plan or systematic transfer plan, STP, it is happening only in the mutual funds. I'm not sure why the insurance companies are not being mentioned in this article, but we need to check. In addition, approximately 25 to 30,000 crores is being invested in equity markets by EPFO as a part of 15% allocation to equity market. A recent report suggests that the government is now proposing to gradually increase to 20%, which means more money would be coming in the Indian equity market. So the government is trying to make sure that if foreign institutional investors would continue to quit, right, then the additional money can be pumped into the system. But there is a problem. As job losses is going up significantly, like if you look at IT companies, the attrition rate is around 15 to 20%. In many cases, it is more than 20%. Now, the big question is whether this attrition rate, which IT companies are saying, is this an attrition rate or this is the firing rate? That's the more important question. Because if 20% of the workforce in IT company is quitting, then who is employing them? Who is giving them jobs? Because in service industry in India, we have only IT companies. Who is giving them job? Manufacturing is giving them job. Retail sector is giving them job. The banks are giving them job. The loss-making startups are giving them job. Who is giving them job? That's the more important question because startups are firing. Big companies have hiring freeze, cost cutting. Who is giving them jobs? That's more important. Henceforth, the very important question which comes to me is that in another 1 to 2 years of time, as RBI is forced to hike the rate, because RBI left with no option but not to hike the rate. So as RBI would be hiking the rate, in this eventuality, we may see that the saving systems would collapse. Now, by collapse, I doesn't mean the lexical meaning of collapse. Collapse means it will come down substantially because inflation will go up substantially. Ultimately, saving would be zero or more or less close to zero. That is something which we need to understand. According to the brokerage firm Reliance Security, India is better placed compared to most other nations for attracting investments. How authentic is this statement? That is also subject to a lot of discussions because in the last 8 months, 2.5 trillion has been wiped out by the FII. Now, whether this money would come again or do not come, I don't know. Meanwhile, FII sold around $24 billion in this year. In this year, $24 billion have been sold. Sensex and Nifty has fallen around 9.2%. So I am very clear on one thing, that if Federal Reserve would be hiking the rate, then RBI is forced to hike the rate because RBI left with no option but to counter the rate. If this is the eventuality which is going to happen, and the probability of that eventuality is very high, in this regards, the Indian indices may come down. Please do not treat this as a trading call. So tomorrow, if you're taking any sell or buy or whatever position, it's up to you. I'm not recommending anyone to do this. Let it be honest. To conclude, the next 6 months would be very tough. We need to be very much alert, agile. So many research reports are coming. Which one is accurate, which one is non-accurate? That is a very difficult job now. But the ground reality is not conducive. That is something I can say. And we need to work accordingly. This is Rahul Magan from Treasury Consulting Group. You knew my personal number, 9899242978. Have a great time ahead.